Hello, everybody, and welcome once again to Public Live. I am your host, Kinsey Grant, and I am so excited to dive in today. So let's get to it. Joining me today are Steve Miran and Dan Katz, co-founders and portfolio managers at Amberwave Partners. Amberwave is a firm that has taken a new approach to impact investing that promotes companies that are committed to U.S. job creation, security, and growth. We're excited to learn more about what that means today. Steve, Dan, thank you so much for joining me here on Public Live.
Thanks so much for having us. It's really a pleasure to chat with you and to chat with all the great people out there in the audience.
Absolutely. I'm excited to jump in. And I know that you guys both kind of have unique professional experiences that have gotten you to this point with Amberwave. So I'd love to start, if we could, with just some brief introductions before we dive deeper into current macro environments and how JSG investing fits in. So let's get started with that. Steve, do you want to kick us off with a brief introduction?
Sure. So I was a portfolio manager at a hedge fund, and then during the pandemic, I went to the U.S. Treasury Department where I met Dan, where we were both helping to implement the U.S. government's fiscal and financial response to the pandemic recession. Did lots of stuff to try and get the economy off its back and make the recovery the strongest from a recession that we'd had basically since World War II. I did a lot of work on the Paycheck Protection Program, which helped small businesses. Dan can speak for himself, but he led the rescue of the aviation industry. So, airlines are flying today because Dan. And when we left the Treasury Department, we decided we wanted to do something that continued trying to help investors invest in the U.S. and invest in the economy and make communities a better place for everyone. And so we created a style of investing we called JSG, which stands for Jobs, Security, and Growth. And we want to help savers and investors direct their money at companies that are creating jobs in communities across the country, investing in supply chain resilience and security, and creating economic growth as a driver of broad-based, inclusive prosperity for everyone.
Well, it certainly sounds like you had a productive pandemic as compared to some people. Thank you for the important context. Dan, do you want to add anything to that?
Sure. So first off, it's great to be with you, Kinsey, and look forward to speaking with the audience out there. Hopefully, we'll get some good interaction. Steve already kind of gave a bit about my background, but on top of that, I'll just say before I met Steve while I was serving in the Treasury Department, I was a lawyer and investment banker by training. I was with Goldman. And have a fair amount of background in individual company analysis, and that pairs nicely with Steve's, long history as an economist. Steve has actually got a PhD in economics from Harvard, and between the two of us and our third partner, Tom Dans, we each have what we think of as relatively differentiated perspectives that enable us as a firm at Amberwave to do some really interesting kind of cutting edge analysis on the intersection of returns and impact as well.
And I'm sure that those differentiated experiences create some robust and interesting debate and conversation around what the future in a macro sense and in a specific company by company sense might look like. So with that, I would love to jump into the task at hand, which is, of course, learning more about this JSG investing approach. So, Steve, I appreciate you started us off there with that first answer with a little bit of an introduction to JSG investing. But if you don't mind, let's get a little bit more granular. What exactly does JSG investing mean, and why did you come about, or why did you come to this idea, with the experience that you had in mind? What brought you to JSG investing, and what are the goals with this specific approach?
Sure. So we looked around at the universe of investing and really came to understand that one of the biggest changes in the last 10 years was the rise of impact investing. And a lot of impact investing focuses on what's called ESG investing, focusing on environmental, social, and governance goals. And those are super important, but we wanted to get a little bit more granular with that. And we decided what matters most to us is investing in companies that are creating, healthy futures for communities all across the country. And when we think of that, we think of jobs and livelihoods and people being able to have solid, reliable jobs and feed their families and experience training and upskilling and not just sort of, churn through entry-level jobs and have good life-work balances and all the stuff that comes with good jobs. And we also decided that one of the things that matters most to us is supply chains, because when we look around at the economy right now, we're in the grips of inflation that nobody's seen for half a century, and a significant portion of that is because global supply chains have seized up, right? And part of the issue that's going on with that is that the globalization of the last 30 years has really created an efficiency that corporate America had never seen before. But what we're learning is that it also created vulnerabilities. And if you do a lot of business in Russia, you may wake up one day and find out that Vladimir Putin has started a war. If you do a lot of business in China, you may wake up one day and find out that Xi Jinping has invaded Taiwan. And so extending your supply chains in this manner can really improve efficiency in some senses, but it also gives you a lot of vulnerability to downside shocks. And what we wanted to do is to give investors a way to try and protect their portfolios by that. And so what we do is we look at the supply chain exposures of every company in the S&P 500 and we evaluate them based on their risks of exposure to these types of events that are occurring on a monthly basis now in terms of geopolitical volatility and shocks.
Yeah, it's certainly an important point to draw here that the millennial experience these days is that we're constantly dealing with once in a lifetime geopolitical events that happen, every 4 to 6 months. So I think it's an interesting approach. With that in mind, though, I'm curious about when you compare JSG to ESG investing, which is a theme that we've talked about quite a lot on Public Live over the last several months, what exactly does ESG investing leave on the table that you think JSG investing can better utilize as an investment thesis?
Sure. So I think one challenge with ESG investing is that it means a lot of different things to a lot of different people, and it's really important to look under the hood of the specific product that you're looking at. But if I'm just going to generalize about ESG, really the primary thing that a lot of those funds are focused on is really the environment. And certainly we all think clean air and clean water is important, and considering the environment, alongside lots of other priorities is certainly an important thing to do. But when you're focused on the environment at the exclusion of all sorts of other priorities, you can end up being, overexposed to certain areas, and that can hurt your performance over time. So with ESG, for example, one way to look at kind of the performance of ESG is that it focused on firms that have relatively lower carbon footprints, which naturally over the last 10 years pushed people towards tech and away from traditional energy. And that worked for a long period of time up until about a year ago, when the performance in those two sectors really turned around. And so a lot of ESG strategies have really underperformed. So the way we think about JSG as differentiating from the ESG story, which is kind of a long tech, short energy story, is that actually for us, every company in every industry can be a JSG leader. And with our one product that we have in the market, the IUSA ETF, we actually have representation from technology, from energy, from healthcare, from financials, from every sector of the economy. We're just picking within sectors the absolute best performers on U.S. jobs, security, and growth. And so with us, we're not trying to play a long tech, short energy game. We're really trying to give diversified exposure, but isolate for all of the outperformance that comes with treating your workforce better, with having more secure supply chains, and with contributing to U.S. economic growth over the long term.
Yeah, I appreciate that distinction. And I think that, it is important to recognize that for all of the promise of ESG investing over the last decade, as with any, singular investing strategy, there will eventually become shortcomings. Those exist and we have to account for them. And I think that it's interesting to consider a new approach that is thematic, that does have some sort of end goal in mind, that is not necessarily the kind of, ESG playbook that we've gotten so used to over the last several years. Now, I want to take a second here to talk about this idea of globalization. Stephen, you brought up something that I thought was pretty interesting that I jotted down here. Globalization created efficiency, but also vulnerability. Now, in an investing world that is increasingly international, and I would argue even in some regards completely borderless in some aspects of this economy, why focus on the idea of good for America and focus on this U.S. growth, U.S. jobs, U.S. security with this investing thesis? Why not zoom out? Why just focus on good for America here?
Yeah, so two reasons. One, when you think about impact, one thing that people say matters most to them is what's going on in their local community. And we think that that's very powerful, and people do want job creation in their communities, and they do want, their families and broader, extended families, networks of friends, and broader communities to be prosperous and to be secure. And so we thought that's very powerful, and it's something that people probably want, and we want to give it to them. The second reason is to focus on performance. In a world of geopolitical shocks, the U.S. is relatively isolated and, relatively insulated and therefore more resilient and better able to withstand those shocks. And for example, if you look at what's going on in Europe, Europe is dependent upon Russia for their energy imports. And as a result of what's going on in Putin's invasion of the Ukraine, Europe is having a really difficult time sourcing energy and therefore keeping their industry afloat. We don't have that problem in the U.S., right? We don't have the problem of being as reliant on China as, sort of countries in East Asia are. We just have the advantage that we're better able to insulate ourselves from foreign shocks, not completely, but to an extent. And that means that performance is going to be better. And so in an era of geopolitical volatility, in an era of rolling supply chain crises, the more that you can sort of focus on close to home as we're doing, we think the better able you're going to be to weather those storms and to insulate your portfolio from those types of negative shocks.
Yeah, that certainly makes a ton of sense. And I want to take a second here to potentially utilize the opportunity to talk about a macro event that is taking place here on U.S. soil. When we consider what have been some of the biggest macro stories of the last couple of weeks, I think I would argue that the biggest story influencing markets, at least for investors who are here in the United States, has been the Federal Reserve's approach to interest rates. Anybody who has listened over the last week to anything on Public Live probably knows that last week the Fed raised rates by 75 basis points, which was the largest hike since 1994. I'm curious why JSG is increasingly relevant given recent macro events, of course, that are taking place outside of the borders of the U.S., but more importantly, I think, why does JSG strategy make a lot of sense right now, given what the macro environment looks like here within the U.S. with the actions from the Fed, et cetera?
Yeah, great. That's a great question. So I'd say two things. One, a significant portion of the inflation that we're seeing is because of supply chain seizing up globally. And one of the best ways to fight inflation, one of the best ways to fight supply chain shocks, is to build more secure supply chains. And so companies that have done that are going to benefit in that type of environment, and they're companies that specialize in building supply chains at home are going to experience demand surges. Other companies want to do what they've done and turn to them for products and expertise and intermediates, right? So that's going to be a huge driver of outperformance, we think. The second reason is that because of inflation, as you mentioned, the Federal Reserve has been raising interest rates and is going to continue and is very likely to continue raising interest rates. Now, what that does is put the economy into a downturn in order to control inflation. Now, historically, when the U.S. has a small downturn, the rest of the world has a big downturn. There's an old joke in financial markets that when the U.S. sneezes, the rest of the world catches the flu. And if that's the case, then focusing your portfolio close to home can help deliver outperformance. And we don't just mean owning U.S. stocks over owning, emerging market stocks or European stocks. What we mean is focusing on the U.S. stocks in your portfolio that have relatively less exposure to the places that are going to be more volatile in the middle of a global downturn driven by the Federal Reserve.
All right. I appreciate that. Oh, go ahead.
No. So I was going to say, so a JSG focus, as we do in our ETF, the IUSA ETF, a JSG focus we expect will make IUSA outperform because it's less exposed to some of the things that are driving the macro volatility going forward.
Now, with that in mind, another aspect of the macro volatility that we've been talking a lot about here on Public and I think just in the media in general is the J in JSG Investing. Jobs have been a huge part of the conversation recently. So as far as the labor market is concerned, we're looking at what could be a really major macroeconomic trend impacting publicly traded companies. To your point, we're talking about the U.S. labor market, but that could mean more than just the jobs that are either given or not given here in the United States. So one question that retail investors might be asking themselves is potentially how a labor market can get too hot and what that would mean for the economy, for their portfolios, et cetera. So what would you say the downsides are of a labor market that's gotten too tight, and how can JSG principles of investing try to, at least in some regard, insulate or seek out the companies that are better insulated from a too hot labor market?
Sure. So from a macro perspective, Kinsey, you're exactly right that it's a bit counterintuitive to think that labor markets that are too hot or too tight can be a problem. But the reality is when you really dig into the data, when the labor market gets overheated, meaning unemployment is very, very low and there's a lot of vacancies in relation to job seekers, what tends to happen is that you get some wage increases, but you also get inflation, and you get inflation across the goods and services spectrum. And so when the labor market is as tight as it is right now, what you tend to see is that even though people have a relatively easier time finding a job, the resulting inflation from the labor market being this tight tends to outstrip gains in wages. And that's why real wages over the last year, your after inflation wages, have actually been falling. And so a tight labor market, too tight of a labor market, it can actually be a threat to livelihood. And so what the Fed is trying to do right now is to slow down the labor market, slow down the economy more generally, in order to bring inflation under control and hopefully return the economy to a point where we can have real wages, right, inflation-adjusted wages growing again. And in terms of JSG's interaction with that process, really we think that as the economy continues to move towards maybe a less tight labor market, the companies that are poised to benefit are going to be those companies that have the most productive workforces, that treat their workforces properly, and so really build an ethic and therefore are able to attract more talent and grow quickly and more productively. And so when we do our jobs analysis, we're really trying to find those companies that people want to work for because there's opportunities for career advancement and really to build a career over the long term. And we think those companies are going to be positioned to outperform over the long term as the labor market continues to adjust.
I find it so interesting to think about how complicated and I think nuanced this entire tapestry can be, that, when one macro event happens or one macro trend really takes hold, there are so many different ways of trying to play off of that news, of that headline, of that larger trend. Certainly interesting to consider how the companies that people want to work for are going to outperform. I find that really interesting. Now let's zoom out even further. We can include the S and the G in that question as well. I would love if you could give an example of a company in Amberwave's IUSA fund that really represents those values of security and of growth. We talked about what it means to represent the jobs aspect of this strategy. I would love any specific examples of some companies in the portfolio that you see really as emblematic of this JSG thesis.
Sure. So, one company that I love telling the story of is a company called Mosaic. And Mosaic is a fertilizer company that actually produces all of its inputs into fertilizer in North America, overwhelmingly in the U.S. And what we saw happen is that when Russia invaded Ukraine, the price of potash, the price of ammonia, the price of nitrates went through the roof. And these are all things that go into making fertilizers, right? So all of the inputs into fertilizer went through the roof, reason being that Russia, Ukraine, and Belarus combined export about 80% of the global export market for fertilizers. Mosaic, of course, doesn't take their inputs from Russia, Belarus, and Ukraine. They take their inputs from North America, overwhelmingly the U.S. And so Mosaic, as a stock, went up by 50% when the rest of the stock market sold off by about 20%. And what that does is that allows farmers to continue buying fertilizer, producing food, and put food on the table so that everyone can feed their families and have something to eat and move on with their lives. And that's such a fabulous JSG story because it's an example of where when you look for the resilience in the supply chains, that you're not exposed to shocks like a land war in Eastern Europe, you can actually deliver significant outperformance for your investors.
Yeah, I appreciate the example. Certainly interesting. And I think, over the last year, especially a great example of just how many inputs go into a company getting its product to market. It's obviously not a simple task. And I think it's really interesting to dive deeper into how complicated it can be and what the things that these companies can do to better insulate themselves from macro shocks. Certainly interesting. Now, with that, also, I am curious, are there any companies that you specifically don't include in the IUSA fund, or that, maybe some high profile companies that you do not ever plan to include in the fund? And if there are any, what is the rationale behind that decision?
Sure. So, we first off never say never to any company. I mean, as I mentioned, really what we care about is JSG practices, and any company in any industry can be a strong JSG performer, and certainly companies that aren't in the portfolio, we would like to see them change their practices, and to the extent they do, we would adjust. To give you one example of that I think is also relatively powerful beyond Mosaic, in the technology space, one business that we screened out on our JSG criteria that didn't make the cut is a technology firm called EPAM Enterprises, and that's a company that does IT consulting and software solutions for other businesses. And the reason why a company like CAD made the portfolio and EPAM didn't is because when we look at EPAM's business model, it's essentially a business that's earning revenue in the US, but its labor force is predominantly in Russia, Ukraine, and Belarus. So, at the kind of the big picture, we think the companies that are doing business in the US should be reinvesting in the communities in which they're doing business, and locating that labor in the US or adjacent, and not kind of substituting U.S. labor for foreign labor, which we think is not healthy for the U.S. job market. But additionally, because their labor is located primarily in Eastern Europe, Russia's invasion of Ukraine has thrown their labor force into a tremendous amount of disarray, and as a result, this is a company that's underperformed the S&P 500. It's down about 60% since the start of the year, and we did not have that company in our portfolio. Instead, we have other companies in our portfolio which do better on job security and growth, and that's why IUSA has outperformed the S&P 500 by about 2%, with a beta of 1, which basically means it's all of the outperformance is attributable to our stock selection since the inception of IUSA on January 19th. There are
all of
the other.
Sorry, Dan, you blipped out for a second there for me. I don't know if anybody else. Sorry, go ahead, finish. I'm so sorry.
Oh, sorry. Yeah, I was going to say, there are countless other stories out there, including on our website. If anyone's interested, you can follow us at jsgfunds.com. And also our Twitter feed, we're quite active telling some of these stories about why companies are strong on JSG or not. We're at Amberwave on Twitter, and you can see loads of more content there.
Well, Dan, you read my mind. I was going to ask, where can people find you if they want more information? But sounds great on all of those socials. My last big question for you guys, what comes next? What are you excited about for the next year of this strategy, this thesis, this project? Where do you see it going? And what do you think you're going to be talking about a year from now when we have you back on Public Live?
Sure. So we actually think, much like technology and a shift towards software as a service business models was the predominant story in markets over the last decade. We actually think the biggest force shaping markets for the next 10 years is going to be deglobalization and increased resilience in business models. And we expect JSG companies to benefit from that trend. Now, what the specific news events that impact JSG themes are going to be in the next year, hard to say. I don't know if it's going to be tensions in East Asia, or it's going to be the health of the U.S. labor market, or it's going to be labor disruptions in other foreign jurisdictions. We don't know, but we do know we're in a period of increasing geopolitical tensions across the globe. And as a result, JSG strategies, we believe, are going to be positioned to outperform over this whole period. And as these continual once in a lifetime crises that we've been living through over the last 2 years end up being not once in a lifetime, but actually the new normal.
Yeah, certainly the theme to watch is that everything is the new normal. And I'm certainly excited to see where this JSG theme goes next. So Stephen, Dan, thank you so much for joining me today. I really appreciate all of your insight and all of this important background and context on what you've been working on and what comes next. So thank you so much for joining us here on Public Live today.
Thanks so much for having us. It's been a real pleasure to chat with you, and a real pleasure to chat with everyone out there in the audience.
Thank you so much. All right. And thank you to all of you out there for listening today. I hope you learned as much as I did, and I hope you have a fantastic rest of your Tuesday. I will see you next time here on Public Live.
If you would like to see more content like this, subscribe to our channel and download the Public app where you can listen to these sessions in live time.